You thought knowing more would make you feel better. It didn't. The more financially responsible you become, the worse you feel. That's not a personal flaw, that's a pattern, and it has a very specific explanation. You read the book, you listened to the podcast, you ran the numbers on a Sunday afternoon when you probably should have been doing something else, and afterward, not relieved, more alert, more aware of every place you might be getting it wrong. That's not an accident. Every article you read quietly moved the line. Every standard you learned about became a new way to fall short. You didn't gain clarity, you gained a longer list of things to worry about with more precision. The people who never look at their finances, they're not anxious about expense ratios. They're not lying awake running retirement projections. That particular kind of dread, specific, educated, low grade, and persistent, belongs to you because you paid attention. And here's the part nobody talks about. The anxiety didn't arrive because you're behind. It arrived because you started measuring. And once you started, the measuring never stopped. That's not a motivation problem. It's not a knowledge gap. It's a trap, and it's built into how financial literacy actually works. Let's be clear about what kind of person actually ends up here. Not someone who ignores their finances. Not someone who swipes the card and doesn't look at the balance. Not someone who's never thought about retirement or debt or the slow erosion of purchasing power. You are almost certainly someone who takes this seriously. Someone who has enough self-awareness to recognize that money is important, that habits matter, that the decisions you make now shape the life you'll have later. You've done the work to actually learn things, real things, not just vibes or wishful thinking. That's not nothing. That's actually rare. And it would be easy to tell you that you're doing great, that awareness is the first step, that you should be proud of yourself for caring. But that's not why you're here. You're here because you've noticed something isn't adding up. You've done the reading, you've had the conversations, you've maybe even made real changes, paid down debt, started investing, built some kind of cushion, and yet the anxiety around money hasn't gone away. If anything, it's become more specific, more articulate, more persistent. That's not a personal failure, that's a pattern, and it has a structure to it, a psychological shape that explains exactly why the people who try hardest to get financially literate often end up feeling the most overwhelmed. Picture this. You get a raise, a real one, and for maybe a day you feel it, genuine lightness. And then the brain kicks in. You know about lifestyle inflation. You know this is exactly the moment to redirect the extra income. You know what the optimal move is. And instead of feeling the raise, you're already managing it, already anxious about whether you'll make the right call, whether future you will look back at this moment with relief or regret. The raise became a test before the deposit cleared. That's not carelessness. That's what financial knowledge does to a certain kind of person. It converts experience into evaluation, and evaluations always carried a possibility of failure. This isn't about intelligence. It's not about effort. It's about a very specific mechanism that tends to activate precisely because you're paying attention. Here's what nobody tells you when they hand you a personal finance book. Financial literacy, as most people pursue it, doesn't just give you information. It gives you a new framework for evaluating your own life. And that framework comes loaded with comparisons to where you should be at your age, to what your savings rate should look like, to how much you should already have invested by now, to the dozens of things you haven't done yet or didn't start early enough. Every new piece of knowledge doesn't just inform you, it also creates a new category of potential failure. You didn't know what an expense ratio was 2 years ago, so you couldn't feel bad about paying too much in fund fees. Now you know, and now you check. And now there's one more number to monitor, one more thing to optimize, one more area where you might be getting it wrong. That's the trap. It's not that the information is bad, it's that the human mind doesn't just absorb information neutrally. It integrates information into a story about who you are and how you're doing. And when that story has an ever-expanding list of metrics, savings rate, emergency fund size, debt-to-income ratio, net worth trajectory, retirement projections, insurance coverage, tax efficiency, the story becomes very difficult to feel good inside of, because no one's numbers are perfect across all of them. No one's. The financially literate person doesn't feel less pressure about money. They feel more pressure because they can now see all the ways they're not yet where they want to be, with enough specificity to make the gap feel measurable and therefore real. This is not a side effect of learning. It's almost a guaranteed outcome of how most financial education is structured. It gives you the tools to evaluate yourself constantly without giving you any framework for when the evaluation is enough. And the worst part? You don't even feel proud of your discipline anymore. You just feel behind. That feeling has a name, and it's not laziness, and it's not ignorance. It's what happens when a certain kind of mind gets handed an infinite measuring stick.
The mechanism at work here is something psychologists sometimes describe as a kind of infinite reference expansion, but you don't need the term. You've already felt it. It works like this. Before you started paying attention to personal finance, your sense of how you were doing financially was vague, approximate. You knew whether you felt okay or stressed in a general way, but you didn't have a precise measuring stick. That vagueness was uncomfortable in its own way, but it had limits. There was only so specific your worry could get. When you started learning, you acquired measuring sticks, specific ones. You learned that you should have 3 to 6 months of expenses saved. So now there's a number, and you can compare your actual savings to that number. And if it's short, you feel the shortfall in a concrete way you didn't before. The discomfort became legible. And legible discomfort feels like progress. It feels like you're finally seeing clearly. It feels responsible. But here's what happens next. You address that one thing, or you make progress toward it, and then you keep learning. And the next thing you learn introduces another measuring stick. Now it's not just your emergency fund, it's your savings rate. It's whether you're maximizing your tax-advantaged accounts. It's whether you're invested too conservatively or too aggressively for your timeline. It's whether your will is current, whether you have the right insurance, whether your income is diversified enough. Each piece of knowledge is genuinely useful in isolation, but the accumulation of knowledge creates an accumulation of standards, and the mind that is trying to meet them all simultaneously is a mind that is perpetually behind. This is the loop. You learn something, you create a new standard, you measure yourself against it, you find a gap, the gap generates anxiety, and the anxiety motivates more learning, which creates more standards, which creates more gaps. The loop is self-reinforcing. And the anxiety it generates isn't a signal that you're doing something wrong. It's a signal that the loop is working exactly as designed. More learning, more measuring, more falling short, more urgency to learn more. And here's the part that makes it almost impossible to escape. The anxiety feels like it's pointing at real things, because it is. The gaps are real. The standards aren't invented. But the feeling that you are failing, that persistent background hum of not enough, isn't coming from the facts. It's coming from the structure of how you're relating to the facts. That distinction matters enormously, and most people who are caught in this loop never quite make it. Consider this in an ordinary week. You're in your car, or at the gym, or washing dishes, and a podcast episode starts. A financial expert is explaining the concept of sequence of returns risk, the idea that if the market drops in the early years of your retirement, it can permanently impair your portfolio, even if it recovers later. It's a real thing. It's worth knowing. And for about 48 hours afterward, you feel a low-grade unease every time you think about your retirement accounts. Not panic, just that hum, a new thing to factor in, another reason the future feels slightly fragile. Or think about a dinner with friends. Someone mentions they just maxed out their HSA for the year. You nod. You know what an HSA is. You know it's triple tax advantaged. You thought about doing this. You haven't done this. And now you're holding a glass of wine at dinner with people you like, and there's a quiet calculation happening in the background of your brain that has nothing to do with the conversation you're supposed to be having. Or this one. You sit down on a Saturday to review your investments, something you do occasionally because you feel like you should. You look at your allocation. You look at your returns. You look at what a slightly different choice might have yielded, and 20 minutes later, you close the browser feeling not informed, but vaguely unsatisfied, like you've checked something off a list, but the list somehow got longer in the process. Here's the question worth sitting with for a moment. When was the last time you looked at your finances and felt genuinely settled? Not optimistic, not motivated, not resolved to do better, but actually settled, done looking, okay with what you saw. If that moment is hard to locate, that's not an accident. Or this, you've gotten a raise, a real one, more than you expected, and for a day or two you feel the lightness of it, and then your brain, well trained as it is, starts doing the calculation. You know about lifestyle inflation. You know you shouldn't let spending expand to match income. You know this is exactly the moment to direct the extra toward the investment account. And so instead of feeling the raise, you're managing it, already worried about whether you'll do it right, whether you'll make the optimal decision, whether future you will look back at this moment with gratitude or regret. The raise became another test before the deposit even cleared.
That's the shape of it. Every financial event, good or bad, expected or surprising, passes through the same filter: evaluation, standard, gap. And eventually, that becomes the only relationship you know how to have with your own money. The slow cost of this pattern doesn't show up on a balance sheet, but it shows up everywhere else. It shows up in your relationship, not as arguments about money, those are obvious. It shows up as the moment your partner suggests a vacation and you go quiet. Not because you can't afford it, because you immediately start calculating whether it's the optimal use of that money, whether you should be putting it towards something else, whether enjoying it now means paying for it later in ways you can't quite quantify but can feel. They notice the quiet. They don't always know what it means, but they notice it. It shows up at work. You earn more than you used to, you've been promoted, and still there's this background calculation running. Am I making enough? Saving enough? Will this be enough? The number gets bigger and the anxiety just gets more specific, more articulate, not smaller. It shows up on weekends, a free afternoon that should feel like rest, but feels, underneath, like time you're not using to fix the gap, like you should be reviewing something, researching something, getting on top of something. The loop doesn't pause because it's Saturday. And here's what a decade of this actually costs. Not money, time inside your own life. The years where your finances are basically okay, functional, growing, manageable, but your experience of them is dominated by what's still wrong, what's still missing, the gap that keeps moving as you get closer to it. Those are still years. They don't return. The person at 50 who finally feels financially secure often discovers something uncomfortable. They spent the years when they had energy, health, and young children in a state of low-grade dread that turned out to be mostly optional. The money was never the problem. The measuring was. And the hardest part, the part that makes this particular trap so effective, is that from the outside, it looks like responsibility. It looks like diligence. The person who is always worried about money, always optimizing, always aware of the gap, looks like someone who takes it seriously, which is exactly what they're doing.
But taking something seriously and living well inside of it are not the same thing, and no spreadsheet captures the difference. When you come across a piece of financial advice or information, is your first instinct to absorb it or to evaluate whether you're already doing it and to feel something about the answer? When someone asks how you're doing financially, is there a version of your answer that you keep to yourself, a more honest one that involves more uncertainty than you let on? When your financial situation improves, when something gets paid off, or a balance grows, how long does the feeling of improvement last before it's replaced by awareness of the next thing? Do you find yourself knowing the right things to do, understanding them clearly, being able to explain them, and still not feeling okay? Is there a difference for you between financial knowledge and financial peace? And if there is, when did that gap open, and has it gotten wider or narrower as you've learned more? Not every person who watches something like this is in the same place. Some people feel this pattern in a mild way, a background note rather than a constant chord. For others, it's more central, more consuming. Neither version means something is broken. But both versions are worth naming, because the thing that can't be named can't be examined, and the thing that can't be examined tends to continue exactly as it has been, shaping decisions and coloring experiences without ever quite coming into focus. There's something that changes when you can see a pattern clearly. Not fix it, not resolve it, just see it. When you notice the loop running, when you catch yourself learning something new and immediately converting it into a standard and measuring yourself against that standard and finding a gap, there's a moment available that wasn't available before, a moment of observation rather than participation. You're not changing the loop by noticing it. The loop can still run, the anxiety can still be there. But the observer who is watching it is not entirely inside of it, and that's a different relationship than the one you've been having. The pattern we've been describing isn't a character flaw. It's a very natural outcome of applying a certain kind of achievement-oriented mindset to a domain that never resolves, because personal finance, unlike a degree or a project, doesn't have a finish line. There's always another thing to optimize, always another gap, always another decade to prepare for. The mind that's been trained to close gaps and reach standards will keep doing that work in a context that can never be fully closed or fully reached. That's not stupidity. That's the mind doing exactly what it's been shaped to do in a domain where it cannot quite succeed. Naming that, seeing that structure, is not nothing. It doesn't make the gaps disappear, it doesn't lower the mortgage rate or fix the tax code or extend the years you have left to invest, but it does change what the anxiety means. Instead of being a signal that you're failing, it can become recognizable as the sound of a particular loop running, a loop you can observe, a loop you didn't choose exactly, but one you can now at least identify. That's not a solution. It was never going to be a solution. But it is a different kind of relationship with something that has been running, mostly unexamined, for a while. Here's what you'll probably do after this video ends. You'll think about it for a while. Maybe you'll recognize the loop more clearly the next time it runs. Maybe something about the mechanism will click in a way that gives you a moment of distance from it. And then, at some point this week, you'll come across an article or a headline, or someone will mention something about their portfolio, their savings rate, their plan, and the loop will start again. New standard, new gap, new low-grade urgency to learn more, do more, get further ahead of the thing you can't quite get ahead of. That's not a prediction about your weakness. It's just an honest description of how durable this pattern is. The question worth sitting with, not answering, just carrying, is this: what would it actually feel like to know enough? Not to have everything solved, not to have perfect numbers, just to have done enough thinking about money for today, to close the tab and feel finished rather than interrupted. If that feeling is genuinely hard to imagine, that's worth noticing, not as a problem to fix, as information about how long the loop has been running. If something in this landed, if you recognized a specific moment where the loop showed up for you, write one sentence about it in the comments. Not a solution, just where you saw it. The loop doesn't care whether you named it, but you might.